Hi, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. 5 things today. As always, remember to like this video. And if you haven't done so already, you can subscribe to our YouTube channel to make sure that you get these videos every Friday as we publish them. And if you have a comment, don't be shy. I love to read what our viewers have to say. Second, this week I promised you a special look at Tesla, and we're going to see how that stacks up against Apple. I'll do that after my review of the FANGs this week. Third, the FANGs are starting to concern me now. The average FANG stock is off some 18% on average since their price peaks, and with the exception of Facebook, are on the verge of giving us a sell, not only on the stocks, but potentially the overall market, if I can assume that their leadership remains an important aspect of this current market. Fourth, on September the 30th at 11:20 a.m., I'll be speaking on the Money Show's Canadian Virtual Expo. That's a live online conference. Registration is free. And I'll be speaking on black hole economics, why the rich are getting richer and you are getting poorer. In one of the most ironic twists of fate in all of economic history, the COVID-19 collapse occurred just as the U.S. economy was heading for one of the nastiest setbacks that one could have imagined, due to the dead weight of anti-productive debt that Trump and the U.S. Fed had placed on it. A full recovery is not only impossible, but worse, things may be in store if history is any guide. I'll put a link in the description so that you can register and watch my full video. Finally, just a reminder, for those of you watching FANG Friday who are not SVA clients but want to take that next step and join us, send us an email outlining where you are on your investment journey. This week, our newest client of 2 weeks ago told us that he has already recouped our total annual fees twice over by following what we stated in one of our weekly webinars the day he joined. Talk about a good return on investment. In the coming markets, I hope that we will hear of more of these experiences. Anyway, with that in mind, let's take a look at the FANGs. Well, let's start off with Amazon. And, Amazon had been struggling at its HB4, and it looked a couple of times as if maybe it might break out. But, it just has not been able to do so, and now it's beginning to leave the HB4 kind of away in the dust, potentially now heading for the HB3. Netflix, same story with Netflix. Of course, Netflix has been a pain for quite a long while. Very, very indecisive trading on either side of its HB4 price, so it's not terribly surprising. Now, you'll notice, of course, that there's been a couple of times here in the past that the stock has set back this far, okay, and then recovered, but nonetheless, this weakness at the HB4 is not necessarily a good sign at all. NVIDIA has also tried and actually had a beautiful breakout, but has set right back and actually plunged through its HB4 this morning. It was off about another $20 there. So we're going to see if NVIDIA can recoup and come back to the HB4. Now, in terms of the stocks that actually reached their target, It's interesting. The first one is Facebook, and I had mentioned a number of times that its bubble price, that's 7.4 times its book value, was its previous target in 2017, and again, it turned out to be dead on the same target in 2020, and is now setting back nicely. I would expect that the mid-super growth price, that's 5.5 times book value, is likely to hold for a rebound. But first, let's see if the stock gets there. Alphabet, well, remember what I said about Alphabet? It never quite reaches its mid-super growth price. That's 5.5 times book value. And once again, it never quite got there, and has set back actually all the way to the low super growth price, which is 4.5 times book value, and actually today has sunk through that. So we will be watching very carefully to see whether that stock can pull itself back on side, or whether worse lies ahead for Alphabet. And finally, Apple. Well, Apple staged a nice breakout. This breakout, of course, was due to the news that they were going to have a stock split, and of course, the market, for reasons only known to the Almighty himself, the market just absolutely loved that news, and it ripped up one full break point to its HB5. And by the way, these break points here, well, they are 28% apart. So when you get a nice breakout like this is not, it kind of looks trivial when you look at these charts, but when you actually look at the percentage gains that this kind of action implies, it makes for a very, very nice trade. Anyway, hit there dead on, and has dropped back down to its HB4, and today, with precision, Apple reached that HB4 price, and actually has rebounded off there. So far, so good. Anyway, in conclusion, things are, I think, worrying. Amazon has kind of fallen off the fence, and it looks as if it could be heading lower. That's the HB3, which would be 16 times book value. Microsoft kind of looks as if it's abandoned all hope at its HB2 price. That's 12 times book value, and is retreating backwards towards its HB1 price of 10 times book. Netflix made a brief try for glory and has not succeeded. And NVIDIA, after a very promising breakout, has not only set back to its HB4, 20 times book, but has broken back through that level. Generally, I've got to say, I do not like to see general valuation failures. 1 or 2 is understandable, but 4 in a group of 7 stocks, that starts to become a real issue. Of the 3 stocks that reached up to our upside targets, all have set back, and 2 are positively nerve-wracking. Okay, Facebook reached its old upside target and is in full retreat towards its MSG price, 5.5 times book. As I said, Alphabet got to our targeted valuation level, not quite to that MSG price again, and is set back as I thought, and is now struggling to hold at its LSG price. Apple hit its HB5 price, 26 times book value, and is set back one full breakpoint, is now sitting right on the cusp. Anyway, I promised you that we would take a look at Tesla, and now we're going to do that. And the first look at Tesla I'm going to show is just the very recent action after the company announced that it was going to have a stock split like Apple. And like Apple, the stock just took off like a scalded cat. Unlike Apple, however, Okay, let's go back to Apple, which rose 1 breakpoint, or 28%. Tesla went up 2 breakpoints, okay, from its HB5 to its HB7. Well, look at those numbers, eh? We're looking at 310 to 511. We're basically looking here at a gain of 66% in what, 1, 2, 3, 4 week period, a very, very rapid run before setting back. Now, it has a setback and has now rebounded, and it's going to be interesting to see what happens from here. This is kind of what I call sloppy trading. I would have expected a dead hit down at HB5, but we didn't get it. However, what we really want to do is take a look at a stock, well, at Tesla, from a long-term point of view, and indeed we can sort of take this as generic of extreme growth stocks. So let's go back a couple of years and see what you might have done with Tesla. And the first thing to observe, okay, is back here in from May 2019 to September 2019, the stock basically formed a nice base on its mid-super growth price. That is 5.5 times book value. And then started a beautiful, beautiful rise. It broke out, and by the way, it not only broke out, it actually leapt out over the bubble price. And with that kind of action, we would expect more than simply a 1 breakpoint move. And again, remember, every breakpoint is 28%. So when you get a move from the bubble price to the HB4, which actually is what happened, then you have 28% times 28% times 28% times 28%. You had a heck of a move, okay, from under $100 to up here 168. So a very, very nice gain. Now, the stock, of course, like every other company, got absolutely ravaged here by the COVID-19 bear market, and the stock dropped. It actually dropped 4 breakpoints. In fact, the 4 breakpoints that it had gained since breaking out, and had a dead hit on its bubble price. A dead hit on its bubble price on March the 21st. So at that point, we were looking at a nice rebound. Well, what did the stock do? It went up 2 breakpoints, back 1, up 2, back 1, although very, very brief, you see that, back 1, and then it sort of hung around under the HB3, which is 16 times book value, and then broke out for another nice 2 breakpoint run. Okay, this was looking a bit sloppy, and we thought, okay, maybe the stock, after a beautiful run, has about had it. However, that's when they announced the share split, and we had another, again, 2 breakpoint run, again, another 66% gain here before that setback. You know, as I said in looking at the first chart, I'm a little uncertain as to what's going to happen now, because the trading now is more uncertain than it has been in the past, where we typically get nice hits on breakpoints and therefore signals. However, we've had a nice run so far, so I don't think I don't think the stock owes us anything, to put it mildly. Okay, now for some market advice. Okay, remember last week we looked at the market? As I said last week, the market, as represented by the Standard & Poor's 500, may already have reached its extreme. Now, it missed our actual super growth price target. That's 3.5 times adjusted book value, but it missed it by only 2%. And that actually is not bad. However, historically, in order to get an overall sell signal on the market, we need to have a break of the NASDAQ 100 to confirm the S&P 500. And that break point occurred exactly, or just almost dead exactly, at 10,800, and the market hit there this morning before rebounding. Happily, as I say, there's been a nice rebound, so we can relax over the weekend at any rate. I've said it before, and I'll say it now. SVA is an ideal source of information and support to get you through a bear market. And bear markets need not be as scary as they sound. If anything else, you may want to check out your own portfolio to see how safe you are. Anyway, if what you have seen has interested you, and you would like to see what your own stocks are telling you, then send us an email at info@strategicanalysis.ca. Clients get a lot of benefits, not just access to over 3,000 charts of North American stocks, but daily commentary, trade ideas, weekly webinars where we go into the nitty-gritty details of how to use our service to become a more profitable and better investor. When you sign up, I will personally take you through our system on a one-on-one video teleconference and show you how you can use it to become a more confident and profitable investor. If this sounds like something that you think is in line with your goals, then let's take the next step together. Anyway, for now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week when we see what happens